All right, welcome back. The one thing I really appreciate about my next guest is that he lays it all out there. He gives us a plan and tells us his thoughts on when to deploy that plan. He mentions that this is a buy the dips market. Had you done that on Friday, you'd be smiling today, right? And I don't think he could be even more correct. It's been good as of late. Now, he states that there's a large amount of cash on the sidelines that missed this rally from those April 8th lows, and they're going to be there with every reason to buy with both hands to kind of maybe mute these downdrafts, right? They might not be as deep as we might think. Cash that missed the rally will be there to get in when this market does take a dip, and they're going to try to make up for some lost time. That makes sense, right? There's also a little tidbit in his notes about the government and its penchant for printing money. He says that the money printing is probably not going to stop, and it's going to be good for the equity market, but not good for bonds. He also says a lot more, but we don't want to steal all of his thunder. Please welcome to the show, Mr. Eddie Ghabour. Eddie, thanks for coming on. Great notes again here this morning. All right. You're right. It was a buy the dip market. It was a buy the Friday dip market if you wanted to sell it here on Tuesday. And you're probably thinking that we're going to be in for more of this to come.
Absolutely. And I think the reason why we continue to say that is multiple reasons. Number one, there's still a tremendous amount of pessimism in this market, which is interesting after a run up like this to still have this level of pessimism and even still seeing people trying to short this market, which I think is a very dangerous thing to do. And couple that with the amount of cash on the sidelines that haven't participated, I think you have a natural floor for this market. And so when you get weeks like last week, for those that are underinvested, it's just another opportunity to buy those dips. And I think you're going to get more of that as we get to, you get closer to these trade deal deadlines. And the market may get a little nervous as we go through the end of June and into July, and possibly some delays on the tax bill. You'll get these little panic attacks in the market like we saw last week. But again, I think you're going to see these funds be forced to buy because they have underperformed. And that should give investors confidence that I don't think this low of April that everyone's so worried about breaching is anything we're concerned with here in the short term. So though there'll be some turbulence here, maybe in the coming months or so, look out to December. I think the market's going to be significantly higher when you got trade behind you. And now you can focus on the tax cuts as well as the deregulation. And like it or not, it looks like the printing press is going to keep accelerating. And that's going to continue to be inflationary. And when you have inflationary environments, one of the biggest benefactors in that type of scenario are equities. Whether you agree with it or not, it doesn't matter. The market doesn't care. It's going to go higher in that scenario, in our opinion.
You know how much money I've lost in my life trading what I think should happen versus what I know is going to happen? I mean, it probably took me 15 years to probably get my head around that, and you're exactly right. And to that point, you know what? I think you're, again, right on the fact that there was some dip buying on Friday. That would have normally, about a month ago, that would have really shook the market a lot more than it did. There was some folks stepping in. They bought those markets down, whatever percent they did, and they started to slowly but surely come back on Friday. Didn't you see that?
Absolutely. And the other thing you're seeing, too, is the VIX, right? We're seeing in a range in the VIX that is a pretty investable area to be in, as well as you're seeing lower highs being made in the indexes. So these are all data points, along with the volume being lower on down days than on up days. They're all days data points are pointing that the trend is higher. And the pain trade is higher for many, but you don't want to fight that trend or the tape. I think many people see it get to a certain level and they're like, oh, it can't go any higher. When many times it's the opposite. It busts through these resistance levels and it's off like a rocket ship to the next resistance level. So this is a great market to be invested in my opinion. It's not for the faint of heart, but it never is.
No, exactly right. That's why it's hard. That's why there's people like you so people can give you a call. I want to get back to what you said about the money printing. And I think you're alluding to the fact that this big, beautiful bill is going to come through with more spending. And that's what Moody's didn't like. That's where the downgrade came in, right? And that's going to be the case where we're going to add more to the debt here in the short term. I know there's a lot of folks that think that things are going to turn around when it comes to that. And they're trying to sell us a bill of goods where the debt to GDP ratio is going to get better, but still we're spending more money. I'm not going to fall for that. But I think that's what you're alluding to. So if that's going to be the case, we're spending more money. There's a chance, I don't think we should, but there's a chance we get rate cuts. And again, you've got a lot of the trade deals in the rearview mirror. I'm a pessimist at heart because I'm always looking out. I got used to looking out for what could hurt my customers. But I hate to tell you this. When I look at what I see out there, like you said, going to now to the end of the year, I mean, a lot of the most, if not a lot of that bad news has been in the market. And you're going to get some things here that could really give it, a rocket shot.
It's true. I mean, the worst is behind us from a headline perspective, what could be worse than what we had to deal with in the month of April? I think now as we look forward, the probability of good news versus bad news ratio is on the good news side. We should start seeing deals. And the only thing that could change that is if there's a big hiccup with us in China and it reverts back to where we were. But I have confidence that Scott Bessent is going to be able to come through with these deals with President Trump and the administration that will be like rocket fuel. And look, Treasury bonds are going to continue to be challenged with this deficit continuing to increase in debt. Because the other thing, too, is as good as this is for the equity markets, it is also inflationary when you do these things. And I think the 10-year is going to slowly creep up to that 5% level. And as long as GDP is accelerating, even though it'll have panic attacks on the way to 5% and possibly higher, I think the market will adjust to it. 5%, it should be a normal yield on a 10-year Treasury bond when you look back over history. But we've been with this zero interest rate policy for so long that I think is more of a detriment and is the reason why we have created the bubbles that we've created.
I mean, those rates were just ridiculously low, and people got used to them, and they think that's where we're supposed to be. But I don't know if it's 40 or 50 years, but it's in that range. The Fed funds at 5% is pretty average, right? And I think that the older you are, the more you think that that's not that big of a deal. And hey, if you can't make money at 5%, you need to go back to business school because it's not really that high of a rate. I remember them in the double digits, and so that's where we're at here. I was going to bring that up, but you did it for me. That could be the only fly in the ointment, that 10-year getting up to 5%. But you said as long as we're growing and things look good that way, that'll take a lot of the worry off of that, right?
It really will. And on the path to that 5%, I would expect some panic attacks in the market. But this panic attack is during a bullish trend. So again, that would be a gift to me as an investor if the market is coming down on that news.
Awesome stuff as usual. You got a lot of fan mail here for you. So thank you very much, Eddie. Eddie Ghabour coming to us from Key Advisors Wealth Management. Thanks for being on the show.